Hi all and welcome back to another episode of the ICIS Energy Foresight podcast. It's the second episode 2025 and we are still looking at the year ahead. And with me today I have a special guest, John Kemp, that most of you would probably know is one of the most known figure in the energy market in Europe, but I'd say also globally. Welcome, John.
Thank you for the very kind introduction, Matteo. I'm looking forward to speaking with you this afternoon.
It's a pleasure to have you on our podcast, and it's gonna be a special episode because we've always focused on the main commodities traded in Europe, which is gas, power, and carbon. But since I have you here, I want to obviously start from what is the most traded commodity globally, which is the oil. Crude oil, and the starting point would obviously be geopolitics, but I would probably leave that aside for the time being because effectively, we can't say a lot about geopolitics, but the first and probably only certainty is that nobody knows what's gonna happen, and a lot of conjectures that we can make. But if we go into the year ahead, and what are the main elements, main critical points that the market is facing, I think one interesting one is the trade-off conundrum between the price, which has obviously has been relatively stable, falling over the past 12 months, and what is the market share battle on the other end. So the past year, or probably even longer than that, what we have seen is the OPEC acting as a sort of central bank, trying to balance supply with the needed price, or the target price, so to say, as central banks do when with interest rates and inflation. But that didn't really meet a lot of the expectations or the targets of some of the big players. So if we can say that, is this trade-off, is this balance, this pendulum gonna swing one way or the other this year? What's your expectation? What are the moving parts at the moment?
Well, it's quite tough. I mean, the oil price, front month Brent prices averaged about $80 a barrel last year, which is a little bit below the long-term average. I mean, once you adjust for inflation, Brent has averaged about $90 a barrel since the start of the century. So, prices were already a little bit on the low side. And I think most people around the market do not expect a significant recovery this year. If anything, prices might fall a little bit further. For the last 10 years, I've done a big annual survey of my market contacts, and I get about responses from about 1,000 people around the market. And this year's survey suggested that prices were expected to be average about $75 a barrel, in 2025. And then about the same price throughout the rest of the decade. So, that leaves prices a little bit lower than I think OPEC would probably like. It's challenging for them. I mean, they have, OPEC, Saudi Arabia and its allies in OPEC Plus have been quite successful in stabilizing prices. Even when prices have come under pressure, we haven't seen a sort of massive price collapse over the last 2 or 3 years. They have managed to keep inventories relatively low, but it has come at the cost of quite a large loss of market share. They have lost market share to the shale firms in the United States, but also to other producers in the Western Hemisphere, in Canada, Guyana, and Brazil in particular. And that has been quite painful. Looking forward, I think OPEC would like to both reverse some of those market share losses and a higher price, but they probably can't have both. I suspect that their hope is that, you might see a rise in prices this year, particularly if the United States really toughens enforcement of sanctions on Russia and Iran. That could create a little bit of tightness in the market and prices might rise again. And that might create a little bit of scope for both OPEC Plus and the US shale firms to increase output into a rising market in 2025.
Thank you, John. This is quite interesting, and I think you mentioned there one key factor, which is the role of the new U.S. administration and obviously tariffs becoming a key component of trade flows and prices globally. So can I assume, and I'm gonna be a little bit provocative here, that you're still seeing market fundamentals playing a role in driving the high price globally and not finance in the driving seat as it was the case a few years back?
I mean, for the whole of my career, there's been this very sort of slightly fraught, often a little bit emotional debate about whether the price is being driven by fundamentals or financial players. And generally, I find that when prices are moving in the direction that somebody likes, they attribute that all to fundamentals. And when prices are moving in the direction that they don't like, they blame hedge funds and market speculation. I think the reality is the price is broadly driven by fundamentals, certainly over the medium and long term. In the short term, there is clearly a degree of sort of speculative impact. The way I always say it is that the hedge funds community tends to anticipate, accelerate, and possibly amplify or exaggerate price movements. These are very forward-looking markets, and hedge fund managers are people who are looking about where the price will go in the short to medium term, not just where it is today. So what you tend to see is that when they spot what they think is a tightening market, they will move in, they will buy early, and that tends to that brings that price movement forward. It tends to accelerate it, make it quicker, and it may even exaggerate it. But in the end, as I say, they are generally trading with the fundamentals rather than against them. I mean, it's interesting in today's market. I had a look earlier this week. I mean, at the moment, the hedge fund community has a net long position across crude and products of about 540 million barrels. And that is exactly in line with the average position that they've had every week since 2010. And I think that's driven by a couple of things. There's a lot of uncertainty out there, and there is a sort of a balance between sort of bullish and bearish factors at the moment. On the bullish side, I think there is the possibility of much tougher sanctions enforcement that could take several million barrels a day of Iranian and Russian crude oil off the market. But on the bearish side, I think there is concern that the current tariff wars that we have seen have the potential to be very destabilizing, have the potential to sort of significantly damage market confidence, business confidence, and that could lead to a sort of broader economic slowdown that would be negative for petroleum consumption going forward. So I think until we have some sort of resolution of those factors, sanctions versus macroeconomy, basically, I think the market is going to continue trading at roughly current levels. And there is no particularly strong signal, I think, from the hedge fund community, bullish or bearish at the moment.
Which is, it is the case for a lot of the commodities that are traded globally. But oil, obviously, everything is more amplified for the the interest and presence of a lot of different actors, as you correctly said. But let me pick up on the macroeconomic and on the demand side, just trying to look beyond the next year. But obviously, the next year is already the future. So you mentioned tariffs, sanctions, and the whole macroeconomic cycle as a lever that probably will have downward pressure on the price of oil. But what we saw last year is that yes, demand keeps growing, but the growth rate is decelerating. And without going into the debate whether the IEA is right saying that peak oil is coming at the end of this decade versus OPEC, which is obviously claiming that that's not true. But that deceleration is happening, and we are seeing that in the numbers. Do you see that as a potential lead on any price rebound coming over the next years, or is it just going to be reabsorbed by cycles?
I think the slowdown in oil consumption growth is real. And I think it does create a bit of a headwind for the market going forward, and that will be the case, throughout the remainder of this decade and into the next one. There are a number of factors that will continue to sort of cause oil demand to rise. I think growing populations, increasing incomes, particularly in developing countries, more urbanization, more industrialization. You've got hundreds of millions, if not billions, of people moving into middle class status, where they're going to start to want to do a lot more travel, and that tends to be very oil intensive. So there are some factors that are driving long-term growth. At the same time, we are seeing a number of factors that are working in the other direction. A very rapid rollout of electric vehicles, particularly in China at the moment, and that is starting to have a small but measurable impact on oil demand growth, and it is likely to grow going forward. So I think you're right that there is a real slowdown in consumption growth, and in a market where consumption grows more slowly, that is likely to lead to much more intensive competition between producers. Back in 2008, we were worried about this being a world where there might not be enough new sources of oil. The shale revolution has totally transformed that out. We are no longer worried about there not being, there being a peak in oil supply, there not being enough oil to go around. Now we're in a situation where, the market is growing more slowly, and we have sharper competition amongst producers to supply that remaining demand and protect market share. So yes, I do think it is a bit of a headwind for prices. And I think it's one of the reasons why, even in 2022, following, Russia's invasion of Ukraine, we saw prices rise to perhaps about $120 a barrel, in inflation adjusted terms. But they got nowhere near. Back in 2008, they were at almost $200 a barrel once we adjust for inflation. So, this is a very different world. And I think that's probably why, prices feel very comfortable at the moment, or they feel very sort of, there's no particular trend at $75 a barrel, which is a bit lower than the sort of $90 average that we've seen since the beginning of the century, because I think we've moved into a fundamentally different supply, demand, price regime, as a consequence of the shale revolution.
And the shale revolution has been a game changer in the oil market, but not just the oil market alone. And I think I would thanks for this is a good access for another point that I wanted to discuss in terms of the US becoming the top player in the oil industry as one of the top exporters, but then we've seen it over the past 10 years, but now it has become evident after the invasion of Ukraine after 2022. They are like major gas exporters, which is changing a lot of different dynamics globally. If we look at the relationship between oil and gas, which has always been there from a exploration point of view, if you want a geological point of view, but never from a purely market standpoint, we are seeing these as a new potential link going forward. Yes, in the past, we used to have a lot of gas contracts, oil index that was never. Lots of companies moved away from there over the past couple of decades. Going forward with this, let's say, the new role of the US and the link between the two industries. How do you see the price of oil and the price of gas moving? And do you see that as a tandem, or is there the role of gas would probably take center stage and replace oil, or what's your take?
Oh, that's a tough one. I mean, I think the oil market has been fully mature for some time. We've seen pretty limited growth in oil consumption now for a decade, and prices have been, the volatility, the extreme volatility that we used to see in oil prices has largely disappeared. We've had a couple of very large shocks. We had the pandemic, which was a once in a century shock. And prices actually recovered reasonably quickly from that. We also had Russia's invasion of Ukraine in 2022, and again, prices normalized relatively quickly. And that, I think, is a sign of a market that is now very mature, is very liquid. The volatility has declined significantly. Gas is much less mature. I mean, LNG has only really become a globally traded commodity within the last decade. The market is still somewhat fragmented. The liquidity is not particularly high. But it is rapidly maturing. So I think we are moving into a world where LNG trading is clearly growing a lot more quickly at the moment than oil trading. And I would expect that to continue, and I would expect that market to become more mature over the course of over the rest of this decade and into the 2030s. A lot more price convergence. At the moment, we have a lot of price convergence between Europe and Asia as the two major consumption centers. The United States is still somewhat isolated because of the limitations on the export capacity. But with a lot more export capacity coming on, we would expect to see a greater degree of price convergence there too, probably over a 5-year horizon. In terms of pricing, I think we've really talked quite a lot about oil, and I think it certainly the people I talk to think the market is going to be fairly balanced around $75-80 per barrel for the foreseeable future. Obviously, if we were to have a recession, the price might drop. If we were to have another supply side shock, that price might increase a little bit, but it looks like the market is reasonably well anchored around sort of $75-80 a barrel. Gas is a little bit different. On the North American side, it's pretty clear that $3 per million British thermal units is not high enough to incentivize growth in drilling and to meet the increasing demand from power generators and to meet the increasing demand from LNG exporters. So the market has been running in deficit over the course of the last 9-10 months. It's clear that $3 per MMBTU is not going to be high enough. Prices have already begun to rise. They've doubled over the last 10 months, and they will probably rise further to get the drilling activity to start increasing again and restrain some of that very strong demand that we've seen for power generators. So we're probably looking at prices rising in the United States over the sort of short to medium term. Europe and Asia looks a little bit different. I mean, European prices are now trading at exceptionally high levels. I mean, we're back at over 50 euros per megawatt hour. That's the highest that we've seen for 2 years. And we'd never been at such high levels before Russia's invasion of Ukraine. So these are exceptionally high prices. They are also prices which are fundamentally unsustainable. Large parts of European industry simply are not profitable with gas prices at this kind of level. So, and we've seen a lot of deindustrialization, and we're also starting to see some sort of political pushback. So my feeling is that, we are more likely to see a shift towards lower prices in Europe over the course of the next couple of years. That could come from a combination of a number of factors. Quite possibly further deindustrialization, further plant closures for very energy intensive industries. But it could also come about through a possible relaxation of some of the EU's sanctions on Russia. I think some degree of sanctions easing is very likely to be part of any future negotiated end to the conflict between Russia and Ukraine. I think it will be one of Russia's top asks in any negotiation, but I think it will also be increasingly important for the European Union that there is a desperate need now to bring gas and, by extension, electricity prices down to provide a degree of relief to households, but more importantly, to provide to support the European industrial base. So if we assume that at some point over the next couple of years there will be a negotiated ceasefire or a negotiated peace agreement, part of that, I suspect, will be some easing of sanctions. Whether that is a restart of some of the transit gas flows across Ukraine, whether it is a restart of some of the other pipelines that have been shuttered, or whether it is simply easing some of the sanctions on Arctic LNG, I think is an open question. But, at some point, Europe desperately needs a significantly lower gas and electricity price to maintain its industrial base and to maintain its competitiveness. So, in the medium term, my view is gas price is probably going to rise a bit in North America and probably going to fall potentially quite considerably in Europe as we sort of move into a post-crisis era.
Yeah, no, I think that you described all the elements that are on the table at the moment, all the different pieces. And there is a lot of instability and there is a lot of volatility which is still reflected in the market. And you made me think earlier when you made the point about hedge funds being blamed when the price of oil went up in the past, and which is what effectively is happening right now with the price of gas in Europe, where obviously there are a lot of players which are anticipating a tight market coming out of winter and obviously betting on that. Whether this is going to happen or not, obviously we will observe it and see it. But yeah, it's super interesting, and I guess that it's super interesting to see how the gas market will and the LNG market will mature over the coming years. We are seeing a lot of developments in terms of new contracts. There's a reluctance from a lot of players to sign long-term contracts as in the past, which is a sign of what happened in the oil market 20 years ago and so forth. So super interesting. And John, thanks a lot. It's been a pleasure. I enjoyed a lot this conversation. And yeah, I'll see you again.
Thank you. Pleasure speaking with you, Matteo. Thank you.
Thanks a lot again. And for all of you, if you want to know more about Energy Foresight, please visit our website, cas.com. And to the next time.